Welcome back as we undertake Lesson 4, which covers Chapter 6 and 7 in your text. Chapter 6 covers internal controls and accounting for cash. Internal controls refers to policies and procedures that are designed to detect or prevent fraud. The authors list 9 internal controls. 1. Separating duties so that a theft or fraud requires collusion. The idea is that 2 people can keep a secret as long as one of them is dead. 2. Hiring and training competent employees. 3. Bonding, a form of insurance, bonding key employees. Number 4. Requiring employees to be absent so that a replacement can detect fraud that was taking place. Written procedures for processing transactions. Number 6, establishing lines of authority and responsibility. 7, using numbered documents like checks, sales invoices, and so forth. Number 8, using physical controls, locks, fences, security cameras, and so on. Regular performance evaluations and audits. Even the best system of controls cannot totally eliminate fraud. However, it can greatly reduce the temptation and increase the likelihood of early detection. Cash accounting is critical for every firm. If the business is unable to pay its expenses, it will either be forced to borrow or go bankrupt. Cash includes demand deposits, that is, checking accounts, and various cash equivalents. The latter are generally short-term government and commercial notes that can be quickly and easily liquidated, that is, sold at no loss of value. Controlling cash assets is difficult because of the ease of embezzlement and fraud. Cash has small bulk for high value, and the rightful owner of the currency is hard to prove. Cash receipts and payments should be checked and verified by 2 or more employees. Bank statements should be reconciled with true cash balances as shown in the adjusted cash ledger. Any errors in recording cash balances are recorded in a special account called cash over and short, and an example is given on page 305. For items that are paid by currency rather than by checks, we use what we call a petty cash fund. This is typically a lockbox with sufficient cash for small transactions. We establish the fund with a debit entry to petty cash and a credit to cash. As money is paid out, a receipt for each purchase is recorded and placed inside the box. Thus, the total of cash and receipts remains constant. When the cash runs low, the receipts are totaled and entered into the record with a single entry under the heading of miscellaneous expenses. The chapter closes with a discussion of the annual report, also known as the 10K filing. This report differs between privately held and publicly held companies, but is required by the IRS of all businesses. The report consists of 4 items: financial statements, footnotes to the financial statements, management discussion, and analysis of the auditor's report. Firms that are publicly traded have stricter reporting rules established by the SEC, in addition to the generally accepted accounting practices standards. Chapter 7 presents accounting for receivables. We open with an explanation of how to record uncollectible accounts. 2 methods are described: the percent of revenues and the percent of receivables. Accounting for notes receivable is then described next. And finally, we take a look at credit card sales and the cost of financing credit sales. Also, we take a look at recovering what were thought to be uncollectible accounts, another topic as well. This brings us up to our lesson for Lesson 4, our reading assignment rather. In addition to reading Chapter 6 and 7, you are to do Chapter 6 exercises and problems. And there are 6 problems listed, and then a comprehensive problem on page 336 and 337. I will probably wind up doing that problem in class so that you may not have to report on it, but do attend class to find out. Chapter 7, exercises and problems 1, 2, 3, and 4. Regular small problems and a comprehensive problem. And again, we will attempt to do the comprehensive problem in class to save wear and tear on your poor brain. See you Monday night. Looking forward.